Hey folks, Greg here. Today we have a guest that we've had before, and she's always a joy. And she has a financial background, and I thought that it'd be beneficial to listeners that are not exactly sure about their financial statements, like the profit and loss, otherwise known as the income statement, or the balance sheet and the cash flows. We're going to talk about that today, and just so there's a better understanding of what the things on the P&L statement mean. And that's part one. This is part one today. We're talking about P&L statement. And clearly you wouldn't know everything at the end of this, but it certainly will spark some questions and some interest into what do these things mean. And Stacey definitely has some great points that we can take away from this. So I hope you enjoy it. I know I did. And here we go. Thank you, Stacey. I appreciate you every time. So, all right, folks, enjoy.
Greg Sheldon here, your host of Metal, Steel, Manufacturing, and Business Pro podcast, where you learn everything about the metals and manufacturing industry that make your modern day life possible.
Okay, let's do it. Okay, everybody. So we're here today with Stacey again, and it's awesome to have her. And what we thought we would do today is help everybody out with some stuff. And that is reading some financial statements. So I don't know that much. I know a few things, but Stacey knows a lot more than I do. So she's gonna give us an overview of what is it we want to talk about today, Stacey. We're gonna do the
Profit and loss.
profit and loss today.
Yep.
Okay, so we're gonna go through that, and I'm gonna ask some questions if I have them, or questions that I think may be pertinent, and we'll just it's an educational thing for everybody. So this maybe I'll make it an audio, but I'll also put the video link in the audio, so if people are like, oh, I can't see that, I don't know what they're talking about, so don't have to go into like big descriptions of what's on the screen.
Okay,
so people can go to the video.
Great.
All right, so welcome. Thank you. How's everything been?
It's been good. Moving and grooving. Tax season, so
Oh yeah,
it's been super fun.
Well, we're doing this in your busiest time of year, right?
Yeah, it's true. But it's been a good busy. This year I feel like more than any other year I've gotten my systems and my processes like on lock. So I am less stressed than I've ever been in my career, going through tax season, which is wonderful. And these trainings and a lot of the educational stuff that I'm getting to focus on this year that I haven't done in the past has just really been energizing. And so yeah, it's been super busy, but in a really fun, really cool way.
Good. Well, kind of like what we talked about last time. It's like doing the stuff that only you can do and letting the software or whatever do the automation crap.
Right. Exactly. Yeah.
Cool. Well, I thank you very much for coming to help everybody out with this topic. So
yeah.
Where shall we start? What is a profit and loss statement?
So I know that we're going to be doing a few of these videos so that people get to see kind of various financial statements. So I just want to set some like norms. One particular thing that I want to have established from the beginning is like, what is the accounting system? Because a lot of times you'll hear me say things like that hits the profit and loss or that hits the balance sheet. And people are like, what in the world is she talking about? And so just to give some clarity around that first, accounting is a double entry system. And that means that every single transaction hits two places, two different accounts.
Okay.
Usually the easiest way to understand this is with an expense. An expense hits your bank account, right? It clears your bank account, so it changes your bank account balance.
Mm-hmm.
And it also hits an expense account, which is tracked on your profit and loss statement, right?
Okay.
So every transaction hits two places. Most often, it's going to hit an account on your balance sheet and an account on your profit and loss statement. But when we get into recording the segment on balance sheets, you'll see that there are a few types of transactions that only hit on your balance sheet. So just to kind of have that language established so that when I start talking about that stuff, it's a little bit more clear.
Yeah, okay. Fair enough. Yeah, I just want to touch on something that I've learned too. There's different nomenclature for things like revenue. Sometimes it can be called sales. It can be called turnover in Europe. But do you like to stick to a certain terminology or?
No, I think I just like to have it established that all of those things are the same, right? So if you are a product-based company, you're more than likely going to call it either sales or sales of product income, right?
Okay.
If you are a service-based income, you might call it service revenue or service income or something like that.
Okay.
Where I do want to distinguish is that there's a difference between like sales type revenue and income and other income. So other income would be things like interest income or like credit card rewards.
Okay.
Those would be the types of sales that you would want to differentiate between. But overall, just know sales, revenue, income, turnover, same concept.
Okay. Good. Good.
Yeah.
All right. Awesome. Okay. So, and if it comes up where I'm like, because there's other words in the sheets that could be different elsewhere, I'll
Yeah.
try and remember to say something.
To point them out. Yeah, awesome.
Okay.
Well, and that's a great segue into the profit and loss statement because that is one that has multiple names. Your profit and loss is also called your income statement. It's also sometimes called your statement of operations.
Hmm.
All three of those titles are for the same form.
Okay.
So essentially, your profit and loss statement is there to track your income and your expenses. But I like to get a little bit more specific with it and say that it tracks your taxable income and your deductible expenses. That'll help us kind of clarify some of the other things that we're going to talk about what's not on your income statement,
Okay.
right? So the profit and loss is basically that. This is your taxable income or your sales revenue plus any interest income or other income type taxable monies that came in, minus all of the different types of outgoing money that are deductible expenses.
Okay.
Right? So that is your income statement. Yeah. What
Okay.
from there?
Okay. Sounds good. So how do you want to do it? Do you want to put a sheet up or do you want me to keep asking questions or how would you
Sure.
like?
Yeah, let me show you just here's an example of a profit and loss. Now, all of these examples that we're going to be talking about are run out of Xero. There is a demo company, which allows me to just kind of put financials up that are non-specific to any company. One of the downsides of the demo company, though, is that the information is not robust. So if you're $1 million company, these numbers look like chump change to you. Just know that this is a demo company, and there's going to be some things on your income statement and balance sheet that are not going to be showing up here. But did I share my screen? Did I do it? I didn't do it. I didn't
No,
do
no, you didn't. Oh, there we go. You did it.
it. Expert accountant, terrible at Zoom. Okay.
There you go.
So this is your income statement. So again, you've got your sales and your revenue type income up at the top. You got your cost of goods sold. So your cost of goods sold is going to be the actual cost of producing the goods that you sell. So really costs of goods sold, right? If you make candles, the glass, the wax, the wick, right? All of those things are the cost of the good that you're selling. Metal fabrication, it might be, the cost of the metal that you are fabricating into a product that you are delivering and then installing for a larger price, right? The
Right.
cost of the good that you're selling.
Okay.
Then you've got,
I got a question.
yeah,
Um,
I know I get excited. Jump in
no, that's
anytime.
okay. That's okay. So now that I have permission, I'll be jumping in constantly. No.
Cool, please.
The labor. So the cost of goods to make things, because we're talking to an audience that makes stuff, right? So there is the labor cost going to go in your total, like your cost of goods sold.
I go back and forth on that, and it differs per business, right?
Okay.
Typically, when I'm going to include cost of labor as a cost of goods sold is going to be if I am, say, a contracting company and I sell a home remodel for $25,000 and I outsource 15,000 that to various contractors, right? I would include that as a subcontractor's cost of goods sold. Where it gets hairy, including like normal employee labor into the cost of into your COGS, is that a lot of times employee labor is not specific to a specific product or service that you're delivering, right? Like they might fabricate metal and then also do administration, type tasks, cleaning the office, sending out invoices, those kinds of things. So
Okay.
if the labor is mixed use, I would often try to keep that under operating expenses.
Okay.
If you can be very clear though in your tracking of like, I know that this one employee, all they do is, metal fabrication, and I can even track that down to the billable hour, like maybe I pass off the cost of their hourly with a upcharge,
Hmm.
that I would say can safely be categorized as contract labor or contractor labor.
Okay. So by the hour, and what I've seen, Stacey, is that,
Yeah.
usually cost of goods sold is everything you said, and then it's typically, not always, but the by the hour guy that's, only on the shop floor or whatever, right? But I agree that you can split those things up so that you know which um part of the business is allocating to what, and then you can look at if one's more profitable than the other, right? So,
Yeah.
okay.
Absolutely. Totally true. And if you can be very clear about it from an accounting perspective, it can get a little bit more challenging keeping track. So I just say be consistent
Okay.
and be clear about where you're counting it. But yes,
Cool. Okay.
cool.
Awesome. Okay, so
Anything else on this one?
I'm done with my questions for now.
Okay, okay. Just a quick note, another thing to know about your P&L. There are certain, as I said, other income type monies that move into your company that are not normal sales. Typically, those will show up down here after your operating income, before your net income. I don't have an example on this P&L, but again, that would be interest income, credit card rewards, gain and loss on sale of assets would be another one that you would typically see down here on the bottom.
Hmm.
And that helps you get an idea of like, here is my total income. This is what it costs me to generate that income straight off the top. So that's my gross profit, right?
Hmm.
And then I've got all these expenses that it costs me to run my business, which gives me my operating income. And sometimes your operating income is going to give you more information than once you start factoring in things like, now here's my credit card rewards. And then we also sold this piece of equipment. Your net income is going to be the profit that gets claimed on your tax return. So all of these other income and expense types will be factored in. But if you want to know what the cost of running your business for a specific period was, the operating income might give you a more accurate picture.
Okay. Okay. So, when you come, every profit and loss is a little different. You've got your earnings before interest, taxes, depreciation, and
Mhm.
amortization. Is that the same as operating income?
I am not going to answer that question because I don't have full clarity on it.
Okay, fair enough. Okay.
Yeah.
All right. So then we've got net income, and then I always get confused because people say net, net, net. What do people mean by that?
Yeah. So net income is your income less your expenses. So think about on a paycheck, for instance. Your gross pay is your total pay, right? Exactly what your W-2 is going to say that you earned.
Mhm.
Then once you take out all of your taxes and deductions for health insurance, retirement contributions, et cetera, you've got your net pay. So the net is gross less everything being deducted. In this case, it's your gross sales less everything being deducted. So your net income.
Okay. Okay.
And as I mentioned earlier, your net income is going to be what is the taxable income on your tax return.
Right.
So once you add in all of these other income types and once you subtract all of your operating expenses and COGS, that's what you're going to pay taxes on.
Okay. Um, so would you want to keep that as low as possible?
Different trains of thought on this. I
Okay.
come from the profit first model. My goal is to create and run profitable, resilient, fiscally healthy companies.
Hmm.
There is a historical train of thought in the accounting industry that you want to minimize taxes by maximizing expenses. I
Hmm.
say maximize your legally deductible expenses and create a healthy company. And
Fair enough.
so you want your net income to be as low as legally possible while still maintaining financial health and operating on a sustainable budget. That's how I would say.
Okay. Okay. So operating expenses, what kinds of things, so you say legal, what is not legal when it comes to operating expenses, like trips to the Bahamas and stuff? Is
Right, right.
that
So most often it's going to be, like owner expenses that are really for the benefit of the owner, not for the business.
right?
So yeah, you take your family to a trip, on a trip to the Bahamas, and then you pay for it on your company credit card, not a legally deducted expense. Also, there are a couple of types of expenses that are, and I was going to get to this later when we talk about some of the sort of caveats to know, but there are certain expenses that are actually not deductible for your business, like entertainment. That is
Oh,
something that a lot of business owners don't know, because entertainment used to be deductible in the past. Nowadays, if you take one of your clients to a basketball game, the tickets are no longer deductible. If you take one of your business partners out to play golf green fees are no longer deductible.
hmm,
So those are not legally tax deductions that you could put on to your profit and loss and have that offset your income for tax purposes.
interesting. Okay.
Yeah.
Um, is that applicable everywhere, or is that just where you are? I'm not sure. I don't know
That's
if,
IRS. So in the United
yeah,
States, if
okay.
this is an international show, I don't know all the regulations in other countries, but here
What?
in the United States, I know. Here in the United States, entertainment is not deductible, and most meals, almost all meals that you're going to pay for your company are only 50% deductible. There are some caveats, but I always encourage people, business owners, to be very clear when they're taking a meals deduction on whether or not they're actually 100% deductible.
Hmm, hmm.
An example of a 100% deductible meal would be your office Christmas party. When you have that catered with food trucks and blah, 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 right? Like that would be 100% deductible.
Right.
50% deductible meal would be you take your business partner out for lunch so you guys can discuss the latest project that you're working on.
Okay.
Not 100% deductible. Even
Okay.
travel meals. If your travel meals are not being reimbursed by your client, they are not 100% deductible. So
Hmm.
just some of the things to
Very
know.
good. Yeah,
Yeah,
that's really important to know.
yeah,
I did not know that because you just assume, oh, well, that's
right,
100% because you're going for work related lunches, right?
right.
Okay. So overall, like what is the profit and loss telling? Obviously, it's telling us profit and loss, but are there things we can learn from this when we look at it? Or you,
Yeah, yeah, I love it. I love that you asked that. So I want to show a couple of different variations of a profit and loss so you can see. So this here is your standard profit and loss. What this is going to tell you is how much you sold, how much it cost you to sell that. If you're a service-based business, often you're not going to have cost of goods sold. I don't have COGS on my income statement as an
okay,
accounting firm.
right,
And then your operating expenses. So the cost of operating your company, this will be everything from your rent and utilities, your paying your accountant, automobiles expenses, advertising, all of that stuff, right? And then what your net income or your taxable income is going to be at the end of the period, right? So that is your standard P&L. With this alone, you can really start to assess your company's financial health. For instance, did I make money or lose it? Right? If you are showing a loss on your net income, then what that's saying is that it cost you more money to run your business than you made. There's certain kind of caveats to that in that if you show a profit before depreciation on assets, for instance, that could signal that you were cash positive at the end of the period, but we recorded depreciation and that took you into a loss. But all in all, your net income is going to give you a good measure of your fiscal health.
okay,
Also, you can start to look at the percentage of your revenue that it takes to uh, do your sales. So your cost of goods as a percentage of your income will tell you what your markup is, right? So in this case, they did $23,000 of revenue and it only cost them $1,600. If I ran this report with a percentage of income, that would show you what your markup on the cost of goods was, right? You
yeah,
can also look at each expense as a percentage of your revenue. So in this case, you can see that a little over 33%, 35, a little over 33% was spent on advertising. And so you can start to look at industry averages for different types of expenses. So that's one way that you can use your P&L to just kind of understand your business and how it's working.
Okay. Okay. So percentages is a good
Yes.
way to compare to what your competitors are doing. Is that it?
Yes, exactly. You could say, for instance, like one good measure is like certain industries or most industries have kind of a standard payroll cost. So
Mhm.
if you're in restaurants, you know that your standard payroll cost is going to be higher than if you are a consulting firm, for instance, right? So looking up industry norms and sort of like healthy metrics for businesses in your industry on different types of expenses, that way you can start to say, wow, my payroll is double what my competitor's average payroll is.
Yeah.
Where am I not being efficient enough with my payroll costs?
Okay. Love
Those
it.
sorts of things.
Yeah. So it really gives you an idea of how efficient is the business. Yeah.
Right.
And
COGS is another good place to look for that, and probably COGS above anything.
I'm just going to say that
Yeah.
is a big thing for like trade businesses where cost of goods sold will tell you how efficient are the guys on the floor, right?
Right.
So
Right.
yeah,
Exactly.
sorry to interrupt.
No, no, great. It's great. Great interruptions. So then from
Okay.
there, a couple other types of reports I like to look at. There's the P&L, like a period comparison. So normally this looks like a full year view. The demo company didn't have any data for 2021 for me to compare it to. So I
Okay.
ran, but you can run this same report for, this year compared to last year, this quarter compared to last quarter. And what it would show is this was my revenue for December, this is my revenue for November, and then this is the variance, the difference.
Hmm.
So I sold $4,000 more in December than I did in November, right?
Hmm. Hmm.
Same with your expenses. Where this can get really interesting is, let's say we ran a period comparison for the last 3 years and
Hmm.
looked at the variance. What a lot of people are going to see are things like freight and delivery, payroll, and supplies have increased over the last several years. Even if you're running your business exactly the same way that you
Hmm.
have been for 3 years, you standard income, standard vendors, you've been kind of doing the same business, you're going to start to see where your expenses are fluctuating. And then you can start to address, well, for instance, if my cost of goods went up significantly, this period, this year to last year, is that an upward trend? And does that mean I need to adjust my pricing?
Yeah. Yeah. At
Right?
least leads to a question, right? Like,
Right.
why is that happening?
Exactly.
Which
Exactly.
takes you to further investigation. Yeah. Very cool.
Another one that I like to ask is, am I getting the ROI on my advertising? So if, for instance, you notice a strong uptick in your advertising costs, but you're not noticing a strong uptick in your sales, then
Mm.
probably you're not being very efficient with your advertising dollars.
Yeah,
So that's another place that you can
that's
look.
awesome. Yeah. Um, can you put in percentage points on here to easily see it? I'm just curious. Like if
Yeah, I could. I
I'm
could.
not
Here, let me
asking
go
you,
ahead
not
and
asking you to, I just don't know. Is that a capability of?
like as a percentage of income or as a percentage variance.
Um, well, I guess you already got the invariance in there, so I don't really need to.
Yeah, well, I've got it as a dollar amount, but what
Yeah,
I could do, if I'm running this in Zero, for instance, and that is my favorite software. I think we talked about that last time.
we did. Yes.
Yeah, if you want to run the variance as a percentage, you can do that as well. You just check the box and it would run this report instead of with dollars as a
Okay.
percent increase. So we'd see 100% or whatever increase on advertising, and we'd see, whatever that is,
Yeah.
35% increase on sales,
Yeah.
right?
Okay.
So
Okay. Cool.
yeah, so that's your period comparison. When I send statements to my clients, typically what the profit and loss looks like is I have this month and then this, or the last month, the year that I'm doing the books for, and
Hmm.
then year to date, as well as last year this month and then last year to date. And that allows me to kind of compare how are we doing this year compared to last year. It also can help you prepare for taxes a little better. So for instance, if this was run as a 2022 compared to 2021,
Hmm.
my profit at the bottom would tell me how close am I to last year's tax liability. So if I notice that my profit, for instance, or my net income is up $30,000, then I know I need to prepare to pay more in taxes than I did last year.
Okay.
Some
Yeah.
other places you can use the period comparison.
Hmm.
And then the
Awesome.
last one that I want to show you is the budget variance. So if you are a company that works on a budget and you put your budget figures into your accounting system, you can also run a profit and loss statement that is going to give you all of your different revenue and expense types compared to the budget that you set out earlier in the year. And then you can also run a variance to show you, are you over or under budget? So in this case, the sales are up $7,100,
Mhm.
right?
Mhm.
Advertising is also up $6,900. So at the end of the year or at the end of the period, we're actually looking at a lower net income than was projected.
Right.
The budget variance can be very important if you're doing some kind of cash flow forecasting. Um, yeah. So
Okay. So how does this relate to what's in the bank account? Because I know that a lot of times it's just like, hey, bookkeeper, how much money is in the bank account? I mean, they're related, but how are they related?
they are related, and they're not as related as closely as business owners think. And we'll talk about this a little bit more in the segment on the balance sheet, but there
Okay.
are certain cash activities that hit your bank account, but not your income statement or your profit and loss. An
Hmm.
example would be your owner draws. So if you take a draw out of the company's funds that is not a normal payroll expense, right? Like you pay yourself through wages, you just take it as a draw. That's not going to hit your income statement, but obviously it's going to hit your bank balance.
Okay.
So you can see maybe I deposited $2,300 in sales revenue and I spent all of this money in expenses,
Hmm.
leaving me with $6,500. But if you took $3,000 out of the company, then your bank balance is really only going to be, you know, $3,400.
Yeah, yeah. Yeah, okay. Okay. Um, so how often can you do this report? Could you do this as many times as you want? I mean, at the
Yeah,
end of the day, every day?
absolutely. And I have some people that are that granular with it,
Okay.
where they record all of their transactions and they look every day. And depending on the size of your company, that's advisable,
Yeah,
right?
yeah.
I would say most small businesses can run their profit and loss once a month, and that'll give you the information that you need.
Okay. All right.
So can I throw in a couple of things
Of course.
here, just some notes. So I want to chat some pros and cons, the P&L, and we've already touched on a couple of them. A pro is that, this is really the financial statement that business owners rely on to assess financial performance, right? Are you making money or losing money?
Yeah,
It's really cut and dry.
it
It
is.
is literally the bottom line of your business. When people say the bottom line, they are talking about the bottom line of your profit and loss statement, right?
Yeah.
So that is really clear. There's also a lot of ways, as we've seen, to customize the profit and loss so that you can get different information. We
Hmm.
didn't go into, the fact that you can create various different types of income accounts
Yeah.
that you can track different sales and the costs related to that revenue stream. So you can start to see, well, which revenue streams are more or less profitable, right? So there's so much that you can do with the P&L to tell you whether or not the business activities that you're engaging in are actually making you money. So that is another pro of the profit and loss. And then lastly, this is where you go to look at what your tax is going to be. So your net income is going to tell you what your taxable income is at the end of the period.
Okay. Okay.
Um, a con is that it's not reliable for cash flow. So it won't tell you about those other business activities
Hmm.
that don't hit your P&L. Other examples besides owner draws would be payments on loans or credit cards. And I've seen businesses get into trouble because they think, well, I don't have any money left in my account, so I'm certainly not going to owe any taxes. But they don't factor in that $20,000 of the money that went out last year was to pay back a loan. Those loan payments are not deductible. Whatever you spent the loan funds on in the period that you used the loan funds, those were deductible, right? So I see companies where they took a loss 2 years ago when they bought a big piece of equipment, and then this year they're paying back on that loan. they don't have much money in their bank account because they've been paying on the loan, but they still owe taxes because the loan payments are not deductible, right? So like those types of things you want to make sure that you're on top of and that you understand they're not included on your P&L.
Okay. So this is really just one piece of the puzzle, right? I mean, this is the easiest one. I mean, we all know that. I mean,
we all know this one.
it's just math.
Right.
And I guess it's what are the things, and you're bringing them up, and I appreciate that. What are the things that are not so obvious about it? I guess it's the connection of this to the other ones. Is that what it is?
Yeah, I would say that. I would say that the connection of this, and the connection of this to the balance sheet and the cash flow statement is unless you know accounting and you're familiar with all of this stuff, which many of your listeners and business owners may be, right? But if you're not really clear on all of this, then there are certain things that don't occur to you. It makes sense that when you spend money on something, it's an expense, right? It doesn't necessarily, unless you've been educated about it, make sense that, well, I made that $4,000 loan payment. You mean I can't deduct that from my taxes, right? Like those types of things you really have to be informed about. Other things like the fact that meals is only 50% deductible, or that entertainment is not deductible at all, or that oftentimes automobile expenses are really only deductible as a mileage. And so certain automobile expenses would not be deductible as well. An example of this would be, let's say you put all the gas, you're a business owner and you use a vehicle about 50% for personal and business, right? You put all the gas that you put in this vehicle on your company card. So at the end of the year, you're showing, $10,000 in automobile expenses. But you only tracked, say, 3,000 miles that year. Your deduction is actually the mileage, not the actual expenses. And so your automobile expenses on your P&L would be reduced by the difference. So like those are accountant, like the things that we as accountants know that aren't always immediately obvious to our business owner clients. So those are just some of the things to be aware of. A couple of things I want to throw in here, just a couple of, I call them don't screw it up, right? Because if you're a business owner and you're doing a lot of your own books, there's a chance that you're making certain mistakes that your accountant either is regularly cleaning up for you, or if you aren't working with an accountant, maybe you end up going to one and they tell you, wow, this has been, wrong for a long time, and it's actually going to be pretty costly to clean it up. So I just want to shed light on a few of those before we wrap on this segment. First, loan payments and credit card payments, again, are not deductible. Oftentimes, when I have a company come to me and they haven't had somebody keeping their books, I will find like a loan repayment expense account on the P&L or a credit card payments expense account on the P&L. And those are just like, again, you're a business owner. This isn't your forte. You think, oh, I'm spending money. I'm paying my credit card. I'll put my, Chase card payment here on my P&L and that makes sense to me. When I actually get in there and I have to clean it up, I need to pull all of those payments onto your balance sheet, and we need to record whatever it was that you spent if it's not already being recorded on your P&L. So usually what is happening is you've got duplicate expenses. You're tracking all of your payments,
right?
All the things that you're spending your credit card on, right? You're using your credit card for all these. So those are all captured already on your operating expenses. And then when you transfer money to your credit card, it's being picked up a second time as credit card payment, right?
Wow.
That type of thing can lead to overstated expenses. And then when it gets cleaned up, you've got to go back and amend returns because you took too much in expense deduction. So that would be one kind of common thing that I see happen. Also, again, owner draws are not salary. Often I see officer's salary on the profit and loss when the officer is not on payroll at all. They take draws and they just think, oh, I'm going to code this is officer's salary, because you consider it your salary. An accountant and the IRS would not consider that a salary. That needs to go on your balance sheet under draws. And then another just kind of, this is more of a finicky thing for me. I avoid uncategorized or like other miscellaneous expense types
I
or
see those
income
things.
types all the
annoying.
time.
Yeah.
QuickBooks Online is crazy about them. I don't like them. When you're filing your tax return, I want things to be very clean and very clear. When the IRS comes back with an audit and says, well, what is this $27,000 in other miscellaneous expenses? Then you've got to go through and figure out what they were and all of that. So I say avoid those accounts, code things to the closest possible account, and if there are some things that you're not sure where to put it, most accounting software has already an Ask My Accountant account built into their chart of accounts. So you can just kind of code them there for a placeholder. And then at the end of the year, when you're having a discussion with your accountant or CPA, you can go through those expenses and where they should go.
Okay.
And then sales tax that you remit, that you collected from your clients, does not go to sales tax paid. It actually, that is one of those things that hits your balance sheet, not your income statement. So that is another kind of common thing that I see that I want to caution against. And then the last thing is sort of don't go account happy. And what I mean by that is just because you can create a zillion accounts on your chart of accounts doesn't mean that you want to. You don't necessarily want to have a chart of accounts that has 150 categories on it, because then you've got to read that. And the more simple it is, the more straightforward it's going to be. I've come into a chart of accounts before, or a profit and loss, where there's a different expense account for every vendor. So there was like advertising Canva, advertising GoDaddy, advertising, and you go through all of these and it's like completely unnecessary. And then how much did you spend on advertising? You don't know. You got to sit there with a calculator and add up all the different accounts that are advertising, right?
Okay.
So, keep it simple.
Right. I think the argument against that would be is I would like to know why each one's happening. Why would you lump it all together out of curiosity?
So sure, there are things that we would want to break out, like maybe you want to do client gifts. If you send a lot of client gifts, for instance, you want that separate from, your Facebook ads, right? And that's valid. But there are a lot of other places that you can get information on. Think about it this way. Can you get this information somewhere else? So for instance, I can run an expenses by vendor report in Xero that will tell me how much I paid Canva versus GoDaddy versus Facebook versus, right? And so use the other resources that you have to tell the story of where you spent your numbers without clogging up your P&L.
Okay. That makes sense then.
Yeah.
All right. So if we were to look at that P&L, you're saying chart of accounts. So you click on the top one was advertising. If you clicked on that, there would be a whole bunch of items underneath that, correct? That add up to that amount. Is that how that works? Is that what chart of accounts is?
Your chart of accounts, here, I'll show you. What a chart of accounts is. I'm gonna hop in to my handy dandy demo company here. So if you're using Xero, and in QuickBooks it looks a little bit different, but here in Xero, if you go under accounting, you can go to your chart of accounts. So this is basically all of the accounts that things, when I said that your double entry, accounting is a double entry system and things hit two places, everything hits two accounts. So usually it hits, your checking account and one of your expense accounts, right? But maybe it hits an inventory account and an expense account, or it hits a liability account and your bank account, right? So your chart of accounts is literally the chart of all of the accounts that things can be categorized to in your bookkeeping.
Okay.
This is very customizable. You can add or remove different expense or income categories. The thing that I want to caution people on before they start, going to town on their chart of accounts is a lot of these are created to map over to your tax return. So for instance, there's a line on your tax return for how much did you spend in rent versus, office expenses versus legal and consulting and accounting expenses versus your interest income, right? Like all of those map to your tax return. And so you can create a lot of confusion if you start moving these all over the place and like breaking them out into separate different accounts. I see that happen with meals a lot, where like, you want to track the meals for travel versus the meals for continuing education versus the meals for training versus the meals from advertising. But it can get a little bit unclear what your total meals deduction is once it's being reported in 4 different places.
Okay.
Because the IRS only sees one. They want to know how much is 50% deductible meals.
Right.
And you report all of those different categories in one place. So if you are going to do mostly your own accounting and you do want to customize your chart of accounts, I highly encourage you to get with an accounting professional to have them advise you on what things are necessary, what things are not, what things can you run via other reports in the system so that you don't need to duplicate that information on your P&L, etc.
Yeah. Do you know anybody they can go see?
Well, my email address is stacy@theslcgroup.co.
There we go.
So yeah, I'm one. And if you're already working with an accountant or bookkeeper, tell them about the modifications that you would like to make to your system, and just have them weigh in. Because at the end of the day, they'll be the one preparing your tax return.
Yeah.
They'll know what's reported that way for a reason and what's not.
I think you touched on something really great there, where it's like sometimes they're just cleaning up the mess
Right.
and maybe they're not telling you. I don't know, but maybe that's something as a business owner you should be asking is like, what is it I'm doing wrong? I don't know.
Right.
Does that help anybody if you're asking?
Sure.
Okay.
Yeah. And I mean, people come at like some of your listeners are like, man, I want to understand this. I want to have a hand in it. I want to make sure I'm doing it right, and they're excited about kind of being in the business. And then you've got other people that are listening to this and, no fault to you if this is you, but you're like, man, somebody else do it. I couldn't
Yeah.
care less. Put it wherever you need it to go, just maximize my tax deductions and tell
Yeah.
me if I'm doing anything especially stupid, right? Like that's the information they need.
Yeah.
I love working with the former category of people, and I don't work quite as well with the latter, right? Like I really enjoy having an active conversation. I'm a
Mhm.
profit coach and strategist, so I really want to be like in the business with you, talking about where
Yeah.
you're spending your money and if it's strategic and all of that. So, you know, if you're somebody who wants that level of education and training as you're going through the process, you're not going to find that with every accountant. Like actively seek out somebody who is
Yeah.
in it to train and coach and all of that.
Yeah. Yeah. I feel as though a lot of accountants, it's just about taxes and that's it. And that's nobody's fault. That's just
Right.
kind of the way it's gone, right? And
That has been the historical, the old guard, I would say.
yeah.
Especially nowadays, and we touched on this on our last, conversation, but nowadays with technology handling so much of this,
Hmm.
accountants are really having to look other places to deliver value. And this higher level consulting, advising strategy is
Hmm.
becoming more and more commonplace in the industry.
Yeah.
So it is one thing that maybe wasn't traditional, but you're seeing a lot more of it. And if you're looking for that, there's a great, there are tons of us who geek out over stuff the way that I do.
Yes. Yes. Absolutely. And accounting's an old industry, so everybody listening, it's another industry like ours that's innovating.
Yeah, it
So,
is. Exactly. Exactly.
no.
Quickly, very quickly.
We have to. I mean,
Yeah.
this day and age is just like ever since ChatGPT came out, it's like,
Right.
okay, wow. Like
Right.
we're here now.
Right. 100%. And my industry too, very much. If I kept doing things exactly the way that they have been done for generations with accounting, I could probably sustain some business, particularly with older guard business owners, but
Yeah.
I don't know that I would be able to grow and scale with the what today's, like newer business owners are really looking for. That
Mhm.
strategy, that kind of grit with their businesses. So
Yeah. Yeah,
yeah.
it's appreciated for sure. Okay, so are we doing what are we doing next? Are we doing anything?
Yeah, so I've got the balance sheet if you're ready to
Okay,
jump into that.
all right, this is the tough one.
Cool.
Well, for me anyway.
It is the tough one. It is the tough one.
Greg Sheldon here, your host of Metal, Steel, Manufacturing, and Business Pro podcast, where you learn everything about the metals and manufacturing industry that make your modern day life possible.